Something is happening right now in the silver market that most people won't find out about until it's too late. And I want to be clear from the start. This isn't a prediction. This isn't a forecast. This is something that's already in motion. The data is already there. The warehouses are already emptying. The institutional hands are already moving. And if you've been sitting on the fence about silver, I need you to understand something deeply before this video is over. The exit door, the window where ordinary people can still get into physical silver at anything resembling a reasonable entry point, is closing. Not someday, not eventually, now. Let me show you exactly what I mean. Think about a store, a massive hardware store. For years, this store had thousands and thousands of hammers on the shelves, more than anyone could ever need. So the price stayed low. Nobody panicked, nobody rushed. There was always more inventory, always another delivery truck pulling up out back. But then, one day, quietly, the deliveries started getting smaller. Then they stopped, and the shelves started emptying out. Not from the front, where you could see it plainly, but from the back, from the stock room. And the people working the register hadn't been told yet. The price tag on the shelf still said the same thing, but the hammers were disappearing. That is exactly what is happening to silver right now, except the stakes are not a $12 hardware store purchase. The stakes are your financial future. Let's start with the most important number that almost no one is talking about. COMEX warehouse registered silver inventories, the physical silver that is legally allocated and available for delivery to futures contract holders, have collapsed. Not dipped, not pulled back, collapsed. We've seen drawdowns in the COMEX registered category that would have been considered unimaginable just a few years ago. And it's not just COMEX. The LBMA, the London Bullion Market Association, which is essentially the other great pillar of Western paper silver trading, saw hundreds of metric tons of silver leave its vaults in a single month. Then it happened again the next month, then again. When you pull back and look at the combined picture, COMEX plus LBMA, you are watching one of the most dramatic, sustained inventory drawdowns in the history of silver market infrastructure. And these aren't small numbers on a spreadsheet. We're talking about tens of millions of ounces of physical silver moving out of institutional hands, out of trading vaults, and into the hands of people and entities who have absolutely no intention of selling it back. Who is doing this? That's the question that should be keeping you up at night. Because here's what the mainstream financial press is telling you. Industrial demand, solar panels, electric vehicles, the green energy transition. And yes, that part is absolutely true. Silver is now the most electrically conductive element on Earth, being used at scale in the modern economy. Every solar panel uses it. Every EV uses it. The explosion in grid-scale renewable infrastructure is consuming silver at a rate the mining industry simply cannot match. The World Silver Survey now projects a structural deficit, more silver being consumed than is being produced out of the ground, of tens of millions of ounces in a single year. And that deficit doesn't go away. It compounds. But here's what they're not telling you. The industrial demand story, as dramatic as it is, doesn't fully explain what we're seeing in the COMEX vaults. Because industrial users don't clear out trading vaults. They work through long-term supply agreements and industrial contracts. They don't wake up one morning and decide to take delivery of futures contracts. The entities that are draining COMEX are doing something else entirely. They are sovereign funds. They are central banks operating through proxy accounts. They are the same institutions that spent the last several years quietly accumulating gold, now turning their attention to silver. And they are doing it for a reason that has nothing to do with solar panels, and everything to do with what they believe is coming for the global financial system. Let me take you back in history for a moment, because what's happening right now has a precedent, and understanding that precedent is going to change how you see the current setup. The year is 1979. The Cold War is still a cold fact of life. Inflation in America is running so hot that ordinary families are watching their grocery bills double in a matter of months. Interest rates are rising, but not fast enough. The dollar is being questioned, not at the margins, not by fringe economists, but by finance ministries, by central banks, by the people who actually run the machinery of global money. And in the middle of all this, two Texas brothers, Nelson Bunker Hunt and William Herbert Hunt, quietly begin accumulating silver. Not paper silver, physical silver. Bars, contracts immediately converted to delivery. They believed, not without reason, that the dollar was fundamentally compromised. They believed that hard assets were the only real money. And so they bought and bought and bought. Now, the Hunt brothers' story is often told as a cautionary tale: how they were eventually broken, how regulators changed the rules mid-game, how prices collapsed violently in what became known as Silver Thursday. And that part is true. But here's the part that gets left out. Before the collapse, silver moved from a few dollars an ounce to nearly $50 an ounce. People who understood what was happening early and got physical silver into their hands made extraordinary gains. And people who understood the setup but waited too long, people who kept saying, "It's going to pull back, I'll buy the dip," watched that window close in front of their eyes. The exit door in 1979 didn't announce itself. There was no flashing sign that said, "Last chance to buy under $30." The market just kept moving. And one day, looking back, there was a very clear moment when the price was still accessible and it had quietly, without ceremony, passed. Let me bring you back to the present, because history is rhyming right now in a way that should command your full attention. China. Let's talk about China, because this is a piece of the silver puzzle that even many sophisticated investors are missing. China has been, for years, the world's largest producer of silver. A significant portion of global refined silver output passes through Chinese smelters and refineries. And recently, China has moved to restrict silver exports. Not ban them entirely, but the regulatory friction, the export licensing requirements, the deliberate policy friction placed around silver leaving Chinese-controlled territory has tightened substantially. This is not an accident. China does not make these kinds of moves by accident. When the world's largest producer starts moving to keep its silver at home, you have to ask yourself, what do they know that the market doesn't yet fully reflect in the price? The answer is that China understands something about the coming decade that most Western investors are still in denial about. The industrial build-out that China has been engineering, solar, batteries, electronics, defense systems, next-generation communication infrastructure, is silver-intensive in ways that dwarf anything we've seen before. They need the silver. But more than that, they understand that in a world where the dollar's reserve currency status is being actively renegotiated through BRICS expansion, through bilateral trade agreements denominated in non-dollar currencies, through central bank gold accumulation at a pace not seen since the Bretton Woods era, in that world, silver is not just an industrial metal. Silver is money, and they intend to keep theirs. Now, I want to pause here for just a second, because if you're watching this and you've been thinking about whether silver makes sense as a way to protect some of what you've saved, whether you're approaching retirement, already in retirement, or just watching the news and feeling a growing unease about where things are headed financially, I put together a free guide. It walks through the practical steps that thousands of American retirees are using right now to protect their hard-earned savings through physical metals. It's in the description below. Takes about 10 minutes to read. Worth it. Back to the story. Let's talk about the gold to silver ratio, because this is one of those numbers that sounds technical, but is actually very simple to understand. And right now, it's screaming something important. The ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, going back centuries, across dozens of monetary regimes, that ratio has averaged somewhere between 15 and 20 to 1. That's because silver is roughly 17 times more abundant in the Earth's crust than gold. The ratio reflects geological reality. But for much of the modern era, the paper markets have pushed that ratio to extremes, sometimes 60, 70, even 80 to 1, meaning silver has been dramatically underpriced relative to gold for extended periods. Every single time that ratio has stretched to extremes, it has eventually snapped back, sometimes slowly, sometimes violently. In 2011, when silver made its famous run, that ratio compression was one of the dominant market dynamics. Investors and institutions who understood the ratio were positioned ahead of time, and the people who understood it late, or not at all, were left watching from the sidelines as silver moved so fast the charts barely looked believable. And here's what makes the current setup different from 2011, different from 1980, different from every prior silver breakout in living memory. The structural deficit story wasn't there before. In 1980, silver was primarily a monetary and speculative story. In 2011, it was also largely a monetary story, driven by quantitative easing and dollar debasement fears. But today you have all of those monetary drivers: compounded by a genuine structural industrial supply-demand imbalance that analysts at major research firms are now projecting will persist for years, regardless of what happens with inflation, regardless of what happens with interest rates, regardless of what the Fed does or doesn't do. The solar industry alone is now consuming silver at a rate that strains credulity. We are building solar capacity at a pace that would have sounded like science fiction a decade ago, and each solar panel requires silver. There is no substitute at scale. Researchers have been trying to find one for 20 years. The laws of physics have not cooperated. Silver conducts electricity better than any other material on Earth, and in a world going electric, that property has become economically essential in a way it has never been before. Add electric vehicles. Add the grid infrastructure required to support mass EV adoption. Add the semiconductor industry. Add 5G infrastructure. Add the military and defense sector, which is one of the quieter but substantial sources of silver demand that rarely gets discussed in mainstream analysis. Stack all of this industrial demand on top of the monetary demand, on top of the institutional accumulation happening right now in COMEX and LBMA, on top of China restricting exports, and you have a supply-demand picture that only resolves one way over time. The price goes up, significantly. But here's where the exit door framing really matters, because silver isn't going to wait for everyone to be ready. Markets don't work that way. And what we're seeing right now, the inventory drawdowns, the sovereign accumulation, the industrial absorption, these are the whispers before the announcement, the setup before the sprint. And when the sprint begins in earnest, when the paper market starts to fully price in what the physical market is already experiencing, the door narrows very quickly. Think about what happened in late 2020 and early 2021 when silver suddenly became a topic of mainstream conversation. People who had been watching this market for years watched the price spike in a matter of days as retail and institutional interest collided simultaneously. Physical silver dealers ran out of inventory overnight. Premiums over spot prices exploded. You couldn't buy a Silver Eagle at anywhere near the listed spot price because physical supply had temporarily disconnected from the paper price. The door that had been open for years closed, just briefly, in the span of about a week. Now imagine that same dynamic, except driven not by a Reddit thread, but by sovereign fund positioning, central bank reserve accumulation, and an industrial deficit that is measured in tens of millions of ounces a year. Imagine that dynamic with the backdrop of a COMEX registered inventory that is already substantially depleted. Imagine that dynamic with China having already restricted exports. That is the picture forming right now. And the word breaking in today's title isn't hyperbole. This week, and I mean specifically the inventory data, the deliveries data, the positioning reports that are available to anyone who knows where to look, tells a story that is accelerating in real time. Let me take you to one more historical moment, because I think it's the most instructive parallel available. August 1971. Richard Nixon ends the Bretton Woods system. The dollar is no longer redeemable for gold. The global monetary order that had defined the post-World War II world is abruptly and unilaterally ended. In the immediate aftermath, most Americans barely noticed. Life went on. Prices were a bit higher, gas was a bit more expensive. But the people who understood what had happened, who understood that the dollar was now a purely fiat currency backed by nothing but government promise, those people started moving into hard assets. Gold, silver, real estate, tangible things, things that couldn't be printed. And here's the thing about those people. They weren't conspiracy theorists. They weren't fringe characters. They were bankers, economists, family office managers, wealthy industrialists who understood monetary history and took the basic structural changes seriously. They moved methodically. They converted paper to physical. And by the time the broader public began to understand the inflation implications of a fully fiat dollar, by the time ordinary Americans started feeling it viscerally at the grocery store and the gas pump, the price of silver had already begun its historic move. The people who acted early were protected. The people who waited or not. Now, look around you. Look at what's happening to the dollar's global position right now. Multiple major economies are actively building alternative payment infrastructure to reduce dollar dependency. BRICS nations have been openly discussing reserve asset diversification. Central banks have been buying gold at the fastest pace since records have been kept. The IMF has acknowledged the fragmentation of the global monetary system as a serious structural risk. These are not fringe observations. This is the mainstream consensus of international monetary economists. And silver, which throughout all of recorded human history has functioned as money, as a store of value, as the metal of everyday commerce when gold was reserved for kings and central banks, silver sits at the intersection of all of this. The monetary demand story, the industrial demand story, the supply deficit story, the institutional accumulation story, the geopolitical realignment story, every single major narrative converging simultaneously, all of them pointing in the same direction. This is the moment I want to talk to you directly about something important. If you have savings sitting in a retirement account, an IRA, a 401k, pension money that you've spent decades building, and you've been watching inflation eat into its real purchasing power, watching the stock market swing violently at the whims of whatever geopolitical headline drops this week, watching your fixed income holdings struggle to keep pace with the real cost of living, there is a vehicle called a gold IRA that allows you to hold physical precious metals inside a tax-advantaged retirement account. Gold, yes, but silver too. And right now, given everything I've described about the silver market specifically, it's worth understanding how that works. The process is more straightforward than most people expect. You don't have to liquidate your existing retirement savings. You don't have to take a taxable distribution. There are custodians who specialize in precious metals IRAs, who handle the IRS compliance, who arrange the secure storage of your physical metals in an approved depository, and for people sitting on significant retirement savings who are watching the macroeconomic environment with growing concern, whether that's the debt trajectory, the dollar's reserve status, the geopolitical fragmentation, the equity market valuations that by almost any historical measure are stretched. This is one of the most direct ways to get tangible, time-tested protection into your retirement portfolio without gambling on the next hot stock or cryptocurrency. The guide in the description covers how this works in practical terms. Worth a look if this is relevant to your situation. But let me come back to the heart of what today is really about, the exit door. Let's define precisely what that means. In any market move of historic proportions, there is always a window during which ordinary people, not just institutions, not just sovereign funds, not just the insiders, can still access the asset before the price fully reprices to reflect the new reality. That window is always there in retrospect. Everyone can see it after the fact. The year 2000 was the exit door to exit overpriced tech stocks. The years 2006 and 2007 were the exit door to exit overvalued real estate and mortgage-backed securities. The early 2000s were the entry door into gold before its decade-long bull run. The people who saw those doors clearly, while everyone around them was comfortable and dismissive, changed their financial trajectories permanently. The people who laughed at them, who called them paranoid, who said the market always comes back, many of them are still recovering. Right now, the entry door for silver is still open. Not wide open, the way it was 5 years ago. Not casually open, the way it was when spot prices were a fraction of where they are today. But open. The physical metal can still be purchased. The IRA vehicles still exist and are accessible. The structural story hasn't fully priced into the broad market consciousness yet. Most of your neighbors don't know what COMEX registered inventory is. Most people watching mainstream financial news are still being told silver is a volatile, speculative trade, rather than what it actually is, a monetary metal with the most compelling supply-demand backdrop in a generation, sitting in the middle of one of the most significant geopolitical and monetary realignments in modern history. The exit door is closing, not because of manipulation, not because of some hidden conspiracy, but because the physical reality of supply and demand doesn't care about paper markets indefinitely. It doesn't care about algos or ETF mechanics or what the financial media is focused on today. Eventually, and the timeline is shortening every month, the price of silver in the paper market will have to align with the price being demanded in the physical market. And when that alignment happens, it will happen fast. I want to leave you with something that I think crystallizes the entire picture. There's an old saying in commodity markets: the cure for high prices is high prices. Meaning, when something gets expensive, people find substitutes. Producers increase output, demand falls, and prices normalize. That's how most commodity markets work. But silver has a unique problem. At higher prices, the industrial users can't substitute. The solar industry doesn't have a replacement for silver in photovoltaic cells at current technology. The electronics industry doesn't have a material with comparable conductivity at comparable cost. And on the supply side, there's no silver mine that can be permitted, funded, built, and brought to production in less than a decade. The mines that are running today are the mines we have, and they cannot produce enough to close a deficit that is already running into the tens of millions of ounces annually. This is not a story about a speculative bubble. This is not a story about market sentiment or momentum trading. This is a story about math, about geology, about geopolitics, about the slow-motion collision of industrial civilization's need for silver with a world that has spent decades treating silver as an afterthought. The window that exists right now to get physical silver, to position your retirement savings in a vehicle that holds tangible metal, to be on the right side of what the inventory data and the institutional behavior and the geopolitical realignment are all pointing toward, that window is measurably smaller today than it was 6 months ago. And 6 months from now, if the drawdowns continue at this pace, if China's export restrictions hold, if industrial demand continues to accelerate, that window will be smaller still. If you've been watching this space, if something in this video resonated, if you're approaching or already in retirement and you want to understand the practical steps, not the theory, not more analysis, but the actual actionable steps, that guide in the description walks you through it clearly. The free guide that covers the saving strategies thousands of American retirees are using right now to protect what they've built. And for those of you who made it all the way to the end of today's video, I appreciate that more than you know. For you specifically, there's something extra. If you're an American retiree with at least $100,000 in any retirement account, IRA, 401k, pension, it doesn't matter which, and you want to go deeper on this, you can mention this video when you reach out through the description. There's a complimentary one-on-one educational web conference available. No obligation, no pressure, just a real conversation with someone who can walk you through the specifics of how this works for your exact situation. That's exclusively for people who've watched to the end, which means it's exclusively for people who take this seriously. The link is in the description. The door is open, but not forever.